Hello, my name is Angus Murray. I'm going to give you around a 12-minute presentation on the Equity High Yield and Premium Income Fund. I've given a shorter version of this presentation of about 3 minutes if you wish to review that instead. This is the fund overview. Our ambition here is to have a portfolio of listed developed market equities that we consider to be semi-monopolistic, price inelastic, have strong balance sheets, and therefore are able to generate consistent dividend yields of around 4 to 6%. So the easiest example of that we've given here are Sydney Airport, AstraZeneca, and Singapore Telecom as an idea of the type of companies that we're looking to hold. So the portfolio here is a long-only portfolio. It's unleveraged. It does not give investors any more exposure than the amount of money they're putting in. It is completely liquid. It's a daily traded fund, but also all of the instruments underneath and inside the portfolio are market traded or exchange traded and are completely liquid as well. And in addition to that, the portfolio is completely transparent. Once we hold those stocks in the portfolio, we then try and improve the income into the portfolio by writing a covered call option. So we sell a call option against the stocks we hold inside the portfolio, and we're able to generate an average of a 8 to 12% premium income per annum from writing those covered calls. So the returns of the portfolio are really focused upon the dividend yield and the premium income. Here on slide 3 is an example of the portfolio of stocks that we would hold. You can see that we are diversified here by industry, also by country. Within the individual holdings though, no individual holding exceeds 6%. So we're talking about holdings between 2 and 6%. And you can see here the average net dividend yield, which is after withholding tax, that we are able to achieve from this basket of stocks. And you can see that within that realm, the net dividend yield is 4.89%. And the 60-day premium income, which we've listed here on an annualized basis that we're able to achieve, is just over 14%. So what we're trying to achieve from a combination of the net dividend yield and the premium income is around about a 20% return. Obviously, the stock portfolio is long only and unleveraged, and therefore it does rise and fall with the value of the stocks, but it's this dividend yield and premium income that we're mainly focusing upon. Here, slide 4, just highlighting the portfolio sector breakdown and then also the geographical breakdown. What you'll note is that Australia has a higher weighting than most developed market portfolios. That's due to the fact that Australia has a very good policy of superannuation, and superannuation encourages companies to pay out high dividend yields. And in fact, if those dividends are fully franked, then there is no withholding tax to be paid. Here on slide 5 just talks a little bit about the performance of the single family office portfolio that I have held and do hold at the moment with regard to the same strategy. Within that, I have 19 million US dollars inside those 2 single family offices. What we can see from the performance track record is that in the rising equity market we've had in the last couple of years in the S&P 500, the stocks that we hold have actually underperformed. That's because we are owning a basket of semi-monopolistic, price inelastic stocks and don't hold stocks such as technology stocks. Yet when you add in the dividend and also the premium income that we're able to achieve, then you see that we get an outperformance over the S&P 500. And I think over a longer period of time, irrespective of what the S&P 500 does, it is the dividend and premium income that is the most attractive part of this particular strategy. Here are the dividend yields for the individual countries on a gross basis, and as indicated, you can see here on slide 7 a discussion with regard to withholding tax. Obviously, this is the amount of tax withheld on dividends. It differs by individual countries. So, for example, in Australia, as I mentioned, if a dividend is fully franked, 100% fully franked, then there's no withholding tax. In the United Kingdom, there is no withholding tax, but in the United States, there's 30% withholding tax on all dividends. Slide 8 is the investment process that we go through in terms of determining the stocks, managing the risk, and then continuing to monitor the stocks along with implementing the option strategy to bring in the premium income. The first part of that is to identify the high yielding stocks globally. Then we reduce that by those companies in that list which are semi-monopolistic and price inelastic. Obviously, we are assessing the balance sheet strength and the fundamentals of the individual stocks with regard to their power to pay dividends relative to earnings. So therefore, the dividend policy, the stated dividend policy of the board of directors of those companies is extremely important. Currency hedging, both from the aspect of the investor's investment into this portfolio, and then obviously if we were to have, say, a high weighting in a country like Australia, then we will be hedging the risk of the Australian dollars back into the investor's currency. And lastly, just an assessment on whether or not we write an American call option or a European call option. European call options, as I'm sure you're aware, exercise only on the day, where an American call option can be exercised any point up until expiry. Therefore, if we're selling a call option, writing a call option over an X record date for a company, we're always going to write a European call. So here's an example that I've given with regard to Commonwealth Bank in Australia, and you can see here two screen grabs from Bloomberg on slide 10 and slide 11, just so you can see where that information is coming from. So on the 4th of December, the share price of Commonwealth Bank was trading at $76.55. We determined to write a call option for exercise on the 30th of January 2014, which was 58 days away from the 4th of December, with a strike of $77. So in effect, we were selling somebody else the right to buy Commonwealth Bank from our fund at $77 in 58 days' time. What they paid for that right is $1.53.5, and here you can see that. So that is the premium that would be earned by the fund irrespective of what happens. And obviously, if we're able to continue to do that every 58 days, then what you do is you get an annualized return over that period of time of 12.03% from the premium income alone. In addition to that, of course, you will be getting the dividend income, and you can see here that the dividend of Commonwealth Bank with a share price at $76.55 is 4.76%, and I'll come back to that. So what are the scenarios that can happen? I'll just give you two broad ones. First of all, what happens if the stock rises over the period of time? In this case, it rose, we say, to $79, which was 3.2% away from our purchase price. If that's the case, we've in effect sold somebody the right to buy our stock at $77, which they paid $1.53.5 for. So what that means is that we were only able to achieve a maximum return over that 58-day period of 2.59%. That means we were able to achieve an annualized return over that period of time of that 15% plus obviously any dividend income we get. Now that does mean we underperform the stock by a minor amount, but I think that type of return over that period of time is pretty attractive if we can continue to do it over a longer period of time. But obviously stocks rise and fall, so it is the constant aim of this fund to gain as much dividend income and as much premium income as possible, because it recognizes stocks rise and fall over a period of time. So therefore, now what happens if the stock declines? So if it declines from $76.55 to $67, it's quite a decline, 12%. What would have our fund achieved? Well, the value of that holding would have gone down, no question, because it's a long only unleveraged exposure to that particular stock, being Commonwealth Bank. But we would have received the $1.53.5 in premium income in that 58-day period, and therefore we would have got an annualized outperformance of 12%. Plus, of course, we get the dividend income. So in effect, the decline in the stock is offset by the premium income and the dividend income that comes into the portfolio. And that's what we try and do. As stocks rise and fall over a period of time, really it's the dividend income and the premium income that we're sourcing the major returns from. So to illustrate in these two Bloomberg screen grabs, here it is again, the $76.55 stock price. We then wrote a call option with a strike of 77 on the 30th of January 2014, which is 58 days away. We received $1.53.5 in income from it, and as a result you can see here the premium income on an annualized basis you're able to achieve. Obviously, in addition to that, you are getting, if you hold the stock for a full year, this dividend income, as I cited to you, the 4.67%. And being a 100% fully franked dividend in Australia, there's no withholding tax, so that is therefore a net dividend. I've given the same example here with regard to Deutsche Telekom, just as an idea. Here is Deutsche Telekom on the 4th of December, trading at €11.29. We decided to write a 17th of January 2014 call, which was 44 days away, and we decided to sell that with a strike or use a strike of €11.50. So the fund received in income 22 cents. So in effect, the premium income that was derived from that is 22 cents over the purchase price, 11.29, and you can see that's an annualized number of just under 2%, sorry, a number of 2%, and an annualized number of 11.7%. And it is that income that we're aiming to continue to derive from Deutsche Telekom. You can see here with Deutsche Telekom in terms of its dividend yield, the dividend that is due to be paid out, it is an annual payment and it is currently on a 6.2% return. So if you combine that 6.2 with the 11.7, you can see where we're really trying to achieve the return inside Deutsche Telekom, irrespective of what the stock does. So in conclusion, what is this portfolio? It owns a basket of these solid cash generating companies that we've determined to be semi-monopolistic and price inelastic. They have strong balance sheets and the expected dividend yield from them is 4 to 6%. Having owned the stock inside the portfolio, we then go about the process of selling a call option, so selling a covered call option to hopefully generate an annualized premium income of an additional 8 to 12%. So the portfolio is long only. It doesn't use leverage to overexpose investors. It is currency hedged. It is completely transparent. It is liquid not only from being a daily traded fund, but also the underlying instruments are all daily traded, and it's very simple to understand. So if you'd like further details on that, by all means, please contact one of our sales representatives or any of the portfolios managers would be happy to discuss it with you. Thank you.